So we're here today to talk about Apis Point Energy. I founded Apis Point back in the end of August after doing a lot of fact finding in general on the fuel dealer industry. So the key thing to understand is I founded Apis Point after about 10 years in the energy sector, where I had roles ranging from sales and trading at Citi to the project commodity and infrastructure finance team at Morgan Stanley. And something that I noticed during this time was a lot of the tools that were available to big companies for locking in prices and better aligning with their cash flow could be made available to the fuel dealer industry, which I didn't think was being adequately covered with its current, sort of offerings. So basically, I noticed that a lot of this stuff revolved around cap programs and fixed price programs. And my view was I could build out a platform that basically could do these offerings to a lot of these middle market companies. And I could take sort of the knowledge that I have of energy analytics and markets and basically apply it to this space. And this company would once again eliminate all basis risk and better align with cash flows. And my view was I could build out a platform where you could get pricing anytime on caps, fixed price, and also more exotic contracts with volumetric optionality. So that is kind of the vision of Apis Point and why we founded it and what we intend on doing and why we're here to do this. So today's agenda, we're going to start out by discussing the markets. So first topic is basis, which has become an increasing threat over the last couple of years. And in this, we'll also touch on what happened in the market over the last couple of days, and we'll also touch on the tariffs. The next big item I'm going to talk about is how to mitigate these risks and what people did pre-Apis Point, so pre-2025. And then, of course, my plug, the risk mitigation playbook post-2025, which are the sort of items that Apis Point offers in terms of products for selling fuel and effectively embedding pricing optionality in physical fuel sales. So I'm going to reiterate this again. Apis Point does not deal in derivatives. We actually buy and sell physical fuel, and we embed pricing optionality and sophisticated pricing models that terminals are not willing to offer at all times or not willing to offer at all. So let's start. The first section is basis and increasing threat. So I'm going to break this down really easy. I'm going to start from, the basics, even though some people are really advanced on this call, others are not as much. And let's go and discuss what basis is. So basis is when you don't have a perfect match between your derivatives contract and your actual physical exposures. So, for example, you can have a heating oil dealer in Maine. He sells a bunch of caps and he goes out, takes the money from the caps and he goes and buys some NYMEX heating oil contracts. Now, it turns out that it actually ends up being really cold in Maine. There ends up being a supply disruption, maybe from St. John's in Canada, and all of a sudden Maine isn't getting a lot of heating oil. The price explodes. But it turns out in New York Harbor, there's plenty of heating oil and it's actually a really warm week. And all of a sudden your basis blows out. And effectively those call options that you bought to protect yourself, which are kind of a form of insurance, didn't pay out. That's basis risk in a nutshell. You bought insurance, say for your home catching a fire, it caught on fire, but in the fine print, it didn't match how the fire started, so you don't get that payout. Basis risk in a nutshell, if you think about it mathematically, is your local price minus NYMEX ultra low sulfur diesel. Now, for years and years, you didn't have to worry a crazy amount about basis. It could hurt you, but it wasn't like it was in the winter of 22, 23. And I see that basis getting more volatile. And so why does it exist? So the key thing is you always have a liquid contract, which represents an exact delivery point at an exact time. So, in the case of heating oil, New York Harbor, ultra low sulfur diesel. In the case of propane, Mount Belvieu. And these are the contracts that are the most liquid that people trade. So they naturally use them to hedge. And these tend to be really big supply points with a ton of tanks. So on WTI, Cushing, Oklahoma, right? Now, the fact is where you are physically, that might not actually match the price at the big hub perfectly. And in fact, it never does. Now, if you ever look at a chart, these things obviously move pretty closely together, but there are times where the relationship diverges. And this can be caused by supply disruptions, weather, geopolitical risk, difference in grades of fuel, changes in supply and demand. So they're never going to match perfectly. But look, for a long time, usually relationships do hold and then they break down, which is what I'm getting into in my next slide. So the current state of basis. So as you can see, if you look at our pre-2021 world, basis could get volatile, but this isn't that crazy. It kind of ranges from like, negative 20 cents at its worst to 20 cents. To be exact, what this chart is showing is the basis that's B20 bioheat minus NYMEX ultra low sulfur diesel in the Philadelphia area. So look, this basis could get bad, but it was manageable. If you didn't hedge it out, you probably weren't going to get completely killed. But all of a sudden, things changed a lot with Russia's invasion of Ukraine. And all of a sudden, you see this period from, kind of winter 22, 23, it peaks, but even from early 2021, you start seeing this crazy volatility when you look at this chart. So all of a sudden, you have situations where basis is spiking out as high as $1.50. And, part of why that happened was, Russia invades Ukraine. All of a sudden, there's massive supply disruptions of distillate. Europeans were getting a ton of distillate from Russia. All of a sudden, distillate had to find, a new home to supply Europe with distillate. So all of a sudden, you saw a sucking sound from the refinery complex in North America. And suddenly, you saw all of this distillate had to go to Europe. On top of that, in general, there was the fear of general supply disruption. So all of a sudden, prices just spiked and the basis blew out. So naturally, there were local dislocations. And then to top it off, you had really cold spells in the winter. Interestingly enough, something else that happened was, and a lot of people don't talk about this, a lot of the power plants in New England have the option of running off of diesel. And the price of natural gas went really high. And so, of course, what did they do? They substituted diesel for natural gas. And then, of course, that caused a further spike. So, look, my key thesis here with this company is that basis is going to become a more and more of an ongoing problem. And as you can see, even after these big spikes, these post 22 lines are way more volatile and way more crazy.
Coleman, can I ask a question?
Yeah, of course, David, feel
So
free to.
looking at this graph, the years 2021, 2022 are probably the end of the year, like December 31st, because Russia invaded
They are.
Ukraine in February of
They
22.
are.
So
Yeah. Yes. So as you
yeah,
can see in February, you see that massive spike right
yeah.
there. You are
So that's
correct.
2022. Okay.
Yes. So you see that massive spike right there at the end of the years, and you see the first big spike, then it kind of went down, and then it just completely blew out again.
Yeah. And everyone in our industry went crazy that spring because of these spikes. The spike that happened in November of the same year went completely unnoticed. I wonder why. And you see that second huge spike.
So my bet is it could have also been very much a bioheat regional thing,
Hmm.
because this is actually showing in the Philadelphia area, which is a market that I've been doing a lot of work in. I could also show it in different areas, of course, too.
Yeah. Okay.
And so, yeah, you had these pretty crazy spikes. But the key point of this chart that I'm trying to show is that basis has become all of a sudden a pretty big risk when it used to be, hey, maybe I'll just sit with it and I'll see what happens and I'll lose a couple cents. This is actually people, and you can tell me if you disagree with this, David, this is where people could actually lose their shirts.
Yes.
Okay. Does anyone else have questions? I actually like the idea of doing this as more interactive. Does anyone want to raise their hands? Okay, so we'll continue moving forward. So, basis in today's energy market. So, we're dealing with a pretty crazy time right now. When you think about it, on one hand, you had something over the last week where you just saw prices collapse, collapse, and collapse. Then out of nowhere yesterday afternoon, you have this total fake out and it goes back up after the tariff suspension. But let's talk about all the things going on. If you ever look at inventories right now, diesel inventories are actually pretty low, which is really bullish. On the other hand, you have money managers that with all these tariffs are now saying, hey, we think there's going to be a recession. Let's take a short position in the heating oil market because heating oil serves as a proxy for demand for distillate in general, right? That's bearish and pushes it down. On the other hand, we're kind of living in a period that's the mother of all geopolitical risk, right? When you think about it, you have everything going on from Russia, Ukraine, to Israel and the Middle East, to the Houthis in Yemen, to Iran, to all of this stuff going on, all where a lot of oil is produced. So that is a massive bullish force at the same time. And then lastly, the biggest thing that we're seeing right now is a lot of people think there's going to be an economic slowdown. There's an economic slowdown that hurts demand. There's less of a demand for refined products. Not as many people are driving. not as much trade is going on even within the United States. There's less trucks running on diesel. People are not purchasing airline tickets. The demand goes down, and that hurts price. So look, we've seen all of this happen, and I'm not here to say where I think the market's going to go. What I'm trying to say is there's a lot of forces at play here, which sort of make it more urgent to lock in prices now. And the other key thing that we're seeing too is you have all of these airline companies now, and there was a big headline, I think it was in the Journal today, that basically said everyone wants to come in and lock these low prices. Right now, you're seeing some of the lowest prices that we've seen in the post-COVID world. When I say post-COVID, I mean post-lockdown world, because as you guys know, prices really collapsed during lockdowns, and then they started to go back up, right? So my advice is offer cap programs now, offer fixed price programs now, be a hero to the customers, lock in these low prices. So let's discuss the tariffs. So everyone was really freaking out about tariffs for a while here, as everyone on this thing knows. Everyone thought, oh my God, he's going to do it on energy. And this is going to be a really big deal because actually a lot of people don't realize this outside of the energy space, but a decent amount of heating oil comes from the St. John's refinery in Canada and enters Boston Harbor. A decent amount of oil goes to US refiners in the Midwest that's coming from Canada. And all of a sudden, that could massively affect our prices in this industry. And people were really freaked out. Then, at the 11th hour, the administration announces tariffs are not going to apply to energy. So boom, what did we see? We saw the opposite, where it's basically a total fake out, right? And all of a sudden, prices actually just start collapsing. And we saw it up until they said that the tariff suspension would happen. Well, not suspension, that there would not be tariffs for that 90-day period on people that had not retaliated on us with reciprocal tariffs. So look, the key thing is this tariff discussion going away? No. It's going to increase volatility and it's going to dominate headlines, I'm sure, for the next quarter. So once again, the key thing is we are going to see dislocations. We're going to see geopolitical volatility, and this is not going to change. So first, I'm going to talk about the risk mitigation playbook. Sorry, let me go back. Pre-2025. So I'm going to go into all the ways that people could basically mitigate this risk without APIS point, because I want to give everything its fair share. Because look, there are places where terminals actually offer a really good suite of products that can mitigate this stuff, and there's other places where there don't. And also APIS point can offer, extra days on payments. There's a lot of stuff that we can do to ultimately make it better and work with our customers that, large fuel terminals are not necessarily willing to do. And we can also further mitigate risk that hedge consultants can't mitigate because we fully take on the basis risk. But let's go into this now. So you had two choices before now. One was I'm just going to live with the basis risk. So, I'm going to do a bunch of caps. I'm going to buy a call option on NYMEX heating oil. I'm just living with the basis risk. I'm going to do a bunch of fixed price. I'm going to buy a futures contract, and I'm just going to live with this. Wasn't that volatile. Like, maybe it'll hurt me. I might lose 10, 15 cents, but it's not going to be a death knell that kills my business. And at the end of the day, my customers want this and it helps me lock in customers. Let's be real. The reason for offering cap and fixed price programs is it locks in a customer with you. You put that monitor on their tank, they sign the contract, they can only buy from you. So the other way was I'm going to mitigate basis risks. I'm going to buy that call option, or I'm going to buy that futures contract, and then I'm going to lock in a fixed differential with my actual terminal and my physical buying on the wet barrels. And maybe the terminal would also offer me a fixed price where it's all embedded in one. Not every terminal does that. A lot of them seem to like to do the diffs a lot more than the fixed price, but great. So the key thing was both of these strategies require the dealer to buy a fixed number of gallons from the rack at any given month. Now, one of the advantages, though, I think I'm going to go on this a little bit more later, of when you hedged with the basis risk was, okay, you did the futures contracts, you did the call options, but you didn't necessarily lock in the diff when you just left the basis risk there. You didn't. So you didn't actually have to buy those barrels. So if demand ended up being really low, great, you actually purchased more protection than you needed, but you weren't stuck buying supply that you didn't need. And then when you don't need it, having to pay a penalty. So primary benefits, let's discuss the old way. When you hedge with basis, you had potential upside if the basis contracted. So, basis went down, you can buy at lower prices. Great, you actually benefited off the basis contracting. You took that risk, but it actually played out well. The other thing was for a long time, it was actually pretty solid protection from moves in the market. Basis didn't blow out. We were good. It was fine. Next, the gallons that you would purchase at the rack price are not locked in. Therefore, if demand is low, and I touched on this previously, the dealer did not have to contractually buy the gallons that it didn't need. Now, this was more fine with the call option cap stuff, but it could also hurt you a lot when you think about it with the futures contracts. Because if you did futures contracts, and on one hand, it's really great that you didn't have to buy the physical gallons because you were in a really low demand environment. But let's say it was actually a really warm winter with that low demand environment. In that case, the price is also going down. You're probably getting a ton of margin calls on those futures contracts. But here I'm talking about the benefits. I'll go into that a little bit more later. So hedging to mitigate basis risk. This is where you actually locked in a fixed diff or did a fixed price. What were the benefits? You cannot be hurt by a basis blowout in any way. You are fully locked in. No matter what the price environment is, you have locked in your margins as long as your customer pays you. Your margins are incredibly stable when you did this. So drawbacks. Each of these methods had its drawback. One, hedging with basis. The key drawback was, and as we've discussed this, if the basis blows out, the dealer eats the cost, and this usually happens at a time of high customer demand. The basis has become more volatile, increasing this risk. So basis blows out, you didn't hedge it out, it blows out to $1.50. You're getting killed on every shipment you're doing to your customers. And it really sucks when that's happening. Next, if a futures contract is used to hedge, margin calls become an issue, particularly in the summer when revenues for the business are weak. So, you do a ton of fixed price contracts with your customers, you hedge it out with the futures contract, and it turns out the price is collapsing in the summer. It's still actually pretty low in the fall, and all of a sudden you have these margin calls that you have to pay, and that really sucks for your business because it's also the time when you're not generating a lot of revenue. So hedging to mitigate basis risk, what's the drawback? The key thing is you must buy those physical gallons that you've contracted with the terminal with, no matter what. And if you can't buy them, you have to pay some kind of penalty. You never even got to sell the fuel, and you end up paying through the nose on that penalty. Next, if a futures contract is used to hedge, margin calls become an issue, particularly in the summer when revenues for the business are weak. That's the same issue that you had above, the same exact drawback. Next, the protection can be pretty expensive, and if the basis ends up lower than the locked-in differential, the company doesn't enjoy the benefits. So let's say if you bought a call option and you locked in a diff at 10 cents, that diff actually contracts to 4 cents, you still have to buy at 10 cents and you didn't get to benefit on the diff contracting. So we talked about it from the perspective of the dealer. Let's now talk about this from the perspective of the customer, right? And what the customer is dealing with. So cap program. So the market over the last couple of years has increased in volatility. Cost of call options has went up. I've spoken to a lot of dealers, and what they always say is, but 15 years ago, calls cost so much less. And they did. And now, look, they cost a lot more. Part of it's inflation, part of it's volatility. There's a lot of things playing at a role here, but the key thing is a lot of customers don't want to do the cap because they don't want to fork over the money up front and pay that. It also hurts because, they're not using this till the winter, and there's that psychological thing of I'm paying for something now that I'm not going to get a benefit from for a long time. So we touched on that already. Customers don't like cutting a large check in the summer or early fall before they've received a gallon of fuel. This reduces overall enrollment and leads more customers to choose fixed price options for price protection. Next, fixed price program. We all know what the big drawback here is. That customer agreed to buy from you at $4. The price ends up actually being lower than $4. The customer calls you and says, hey, can I get out of this contract? And he's pissed. It keeps on going down. The customer is very upset, and it can potentially hurt the customer relationship. Even though you've locked the guy in, he's known you for years. He's calling you and is like, I really don't like this contract. People always get pissed with fixed price programs. So let's talk about the risk mitigation playbook post 2025. And this is basically what Apis Points services are that we're offering. And this is my, shameless plug part of the presentation. So everyone just kind of bear with me here. So the key thesis with Apis Point is that a lot of your companies should hedge like a utility. So when you think about utilities, and let's just think about ones that own natural gas fired power plants, they buy natural gas, they sell power. The way how they make money is they're earning a spread between the price they paid for natural gas and the price they paid for power. So a lot of these tools that I'm ultimately going to show you, I actually took from the natural gas market and I'm applying them to the heating oil market. So a lot of large energy companies, for example, and let's run through this. Let's say if you have a power company, right? And they want to win a contract from an industrial company in their area. That industrial company wants to have a price ceiling on what it's going to pay for electricity. So they go, they win the whole, bidding kind of war to get that contract, and they offer the guy some cap on, his power prices. Now they want to lock in that margin. So they go and they now want to buy natural gas with a cap. So they go to a natural gas company, they get offered a cap, and they now are locked in terms of what the maximum price they could ever buy at is and what the maximum price they could ever sell at is. So when prices blow out, they know what margin they're making no matter what. They have fully mitigated the basis risk. Now, your businesses are actually really similar to this in the sense of you're buying heating oil, you're selling heating oil, you're earning a margin. Your customer is very similar to that large industrial user. They want a cap or a fixed price program. They want to be able to lock that in. You now need to, on the other end, with your procurement, buy fuel where you've locked in your price so you can fully lock in and protect your margins. The other key thing that I'll touch on a little bit more in the presentation is oftentimes these contracts will be a little more sophisticated and have volumetric optionality. So, for example, the company that's an industrial user doesn't know the exact amount of time that they'll be running a day. They don't know what their demand fully is. So they might want some optionality in the power contract on the volumes that they're buying. In turn, you're going to want some optionality in volumes on the gas contract. There's a min volume and a max volume. And we'll go into that a little bit later of our three tools. That is the most sophisticated tool that we offer, where you don't actually have to pick up the full volumes and you get some optionality on that. So we've covered hedging like a utility, and that's a big part of my thesis. So let's actually give a real example. Fixed price programs, how would it actually work mechanically with Apis Point? So the fuel company agrees to buy a specified number of volumes of the physical fuel in a specific month at a certain terminal at a fixed price. And, we agree to that, maybe based on a heat curve, maybe based on, some volumes. And basically we quote a price that no matter what, we will sell Apis, being Apis Point, to the fuel dealer at that price at the given volumes of a certain product at a certain terminal. So the fuel company still goes to the terminal with their truck as usual. Everything from an operational standpoint is the same, but Apis Point has the fuel company listed as a carrier. Apis Point actually buys the physical fuel at whatever the rack price is that day and actually takes title to the fuel for a split second. Hence why, as I've reiterated, we're not dealing in derivatives. We're actually buying and selling physical fuel. So we buy it, we take title of the fuel at the daily rack price, and then we hold it for a split second. And then we sell the fuel to the customer at the fixed price. So what does this do for the customer? The customer has sold at a fixed price to its fixed price customers. They have fully locked in their margins. There is zero basis risk with this tool. And they've actually embedded the risk management in their physical buying. Now, there are terminals that offer fixed prices where they do. Apis Point is happy to try and be competitive and, try to offer, maybe a tighter price on this stuff. But there's also places where, the terminal will be what you use for this. But I have found increasingly that a lot of terminals mainly want to offer diffs and don't want to embed the whole thing here. So that's part of Apis Point's fixed price. And we're also willing to talk to any potential customer and figure out where we can price this to be competitive. Next, cap programs. So this is how Apis Point would deal with your cap program and effectively hedge it out through physical fuel buying. So the fuel company agrees to buy a specified number of volumes of physical fuel in a specific month at a certain terminal at the lesser of a cap price or the published price of the rack that day plus a diff. Now I call it a diff, but in reality, it is the premium that someone would have paid on an option. but it is just embedded in the actual fuel buying. So let's run it as an example with some fake easy numbers. Apis Point agrees to sell you fuel with a cap of $3. Once again, these do not reflect market price numbers now. I'm just using nice and easy numbers. The cap is $3. We then agree that we will sell fuel at the lesser of $3 or the published price of the rack that day plus 20 cents, for example. So let's say if the price of the rack is 250, 250 plus 20 is 270, you would pay Apis Point 270 for fuel. Let's say if the price of fuel at the terminal is 290, 290 plus 20 is 310, you would pay Apis Point $3. What we are effectively doing is embedding the option premium in the actual physical fuel buying. So how does this work mechanically? The fuel company goes to the terminal with their truck as usual. We have our customer listed as a carrier, meaning the fuel dealer. Apis Point purchases the fuel at the daily rack price, takes title for less than a split second, same as with the fixed one. Then we sell the fuel, and I'll reiterate this again, to our customer, the fuel dealer, at the lesser of a cap price or the published price of the rack that day plus a diff. Now, there's a reason why people like this product. The key thing is what you're seeing right now with a lot of consolidation in the industry. You'll see a company come in that's pretty big and they'll say, hey, I'm actually willing to offer caps with nothing up front. And, let's offer it for 2 years. So all of a sudden, this company that's doing roll-ups, you're losing customers to them for a 2-year period because that guy's offering a cap from nothing up front. So if you offer the cap and you're not using Apis Point for nothing up front, you're buying that call option and eating the cost. What Apis Point allows for you to do is offer that up front with no cost to your customer and then embed the premium into the actual fuel buying for later. So you can now offer cap programs even out to 3 years, lock in customers, and incentivize people by not having to pay anything up front. Or alternatively, you can just take that cap fee and just pocket it. Either or, not telling you what to do. But my personal view is that it's really great for customer acquisition, this product. And also, why would any of your customers want to do a fix when you can offer a cap for nothing up front? Primary benefits. Complete elimination of basis risk with this product. You don't have to worry about basis anymore. Embedded protection transforms cash flow. You are actually paying when you receive fuel, and when you receive fuel, it's closer to when you actually sell the fuel. So you're not dealing with cash flow issues anymore. Margin calls are entirely eliminated on our fix. We don't do margin calls. We actually look at the financials of our customers, which is why we are willing to work with them, and then ultimately come up with something that works. So we're not in the business of doing margin calls. No more fixed differentials. So if, a terminal is only willing to offer a fixed differential and not a full fixed price, we're willing to come in and just offer it as purely a fixed price. Multi-year contract options for customers. We're willing to go out 3 years on these. Most people are only willing to go out a year and a half, which once again, my plug, lock in these guys for 2 years. Lastly, significant customer benefits, no cap fee, and downside protection for fixed customers. So how do we do it? So the key thing here is Apis Point at all times holds enough capital where we can survive a massive basis blowout. Because at the end of the day, our key part of our business is we eliminate basis risk. It is now fully on our balance sheet. So the key thing is I will never transact on more gallons than I can where I have the cash to meet potential losses. And we run risk models where we look at the 99.9th percentile of basis moves. So for example, we'll look at something crazy where we'll say, let's say that 70 cents is what basis remains at for a 3-week period. And would we survive that? And, we're always running this in different regions and figuring out what is that amount of capital that we need to hold. I would say our business is really similar to an insurance company in the sense of there's a risk that people want to get rid of. They're transferring that risk to us, and we have to hold enough capital to offset that risk. We're experts in understanding basis risk. So as I reiterated, we rely on sophisticated risk models and are able to put positions on and off that mitigate the basis risk so that you don't have to. Because we deal with multiple customers, as the market moves, when we enter in new positions with new customers or as people do new caps and fixed over time, we can help offset some of the risk from previous positions. We basically sit on a book that is big enough where we can mitigate risk over time. And we can also decide when we have to go in and buy extra protection for ourselves. We have software, which is basically in its beta version that's nearly done, which effectively analyzes the relationship between basis and flat price and manages it well. And that is the key service that we are performing here for fuel dealers. So I touched on this already, technology and proprietary software. We're using software that's developed specifically for this purpose that allows for us to protect from the basis risk and better service our customers. So let's discuss these new instruments that we already touched on. So there's the cap. I call it an index cap. When would you use this? You would use this when you sell caps to your customers. It completely mitigates basis risk. And it gives you a minimum profit margin level that's locked in. However, it also gives the benefit for margins to potentially go higher if the price collapses. Same way your own customers benefit off the cap program. What's the key benefit? You never pay more than the cap for fuel, and you enjoy the benefit when prices drop below the cap, same as your own customers. Is there an upfront payment? No. We include the cost of the cap in the fuel price, and it's not payable until it's pulled. So when everyone asks me what happens when there's a warm winter with a low price environment, you benefit from buying the fuel at lower prices. This is a really great instrument. It's really been the most popular one so far. In fact, one of our customers transitioned a lot of his customers to 2-year cap programs with this. He can decide if he wants to pocket those upfront fees or if he can, really want to capture customers and not charge them. It benefits his business. Next, this is the volume flex. This is our more sophisticated instrument, which takes a lot more time to go over. And I'm actually happy to do some calls after with people if they want to discuss. This is the volumetric optionality contract. So when would you use this? You'd use this when you sell fixed price contracts to customers. And look, you could also, there is an optimal way of using it with caps, but that will take a long time to explain. And that's more of a one-on-one type call thing. There's zero basis risk in it. Your profit margins are fully locked in. And what's the key benefit here? You pay the fixed price no matter what, but you have the option to flex the volumes up and down based on your customer's demand with the fixed price program. So let's say you have a minimum volume of 100,000 gallons in January that you have to buy at $3.50, right? You can flex that up to 200,000 gallons. So you have an optionality on 100,000 gallons to also buy at $3.50. Now, obviously, you're only going to exercise that optionality if the price is above $3.50 and if your customers actually want the fuel. So hence, we call this volume flex. You don't have to pick up all the volumes. There's a minimum that you have to buy, and then there's a flex level. And, we're happy to make these bespoke instruments, which are normally done by structuring and origination desks at banks, but our software can really structure this stuff really quick and get you these contracts so you're not stuck buying volumes that you don't need. There's no upfront payment on it. And now let's talk about when there's a warm winter and a low price environment. You would purchase lower volumes at a fixed price and your margin is still fully locked in. You didn't need all those volumes. It was really warm. You don't have to purchase all of them. And that's the benefit of the volume flex. Fixed price contracts, you guys know this, I'm sure, but we'll just reiterate this. This is the most simple one. You'd use it when you sell fixed price contracts to your customers. No basis risk. Your margins are fully locked in. And you have fully locked in margins on fixed price contracts since you are locked in on price and you are paying for fuel. There's no upfront payment, but once again, the issue is you're stuck buying the fuel at higher prices you don't necessarily need in a warm winter, low price environment. So I've enjoyed speaking to all of you today, and I'm happy to answer any questions. We actually have some time, so let me exit the presentation mode on this, and let me actually switch and unmute some of you guys, and we can, discuss some Q&A. So 1 minute, let me quickly, looks like we have a couple people on. If anyone wants to raise their hands and ask questions, please do.
So you mentioned that you can sell at the various terminals. The major terminals in Connecticut, of course, are New Haven and Bridgeport. But do you do the inland terminals as well? I mean, if SAC Energy, a small wholesaler, sells in Broadbrook, Connecticut, can you do that too?
So we can do any terminal once we're onboarded. We actually have our licensing in Connecticut now. And if a customer wants to work out of that terminal, we can work out of that terminal. The key thing is that terminal needs to have some kind of pricing where, it's legitimate pricing. So like, for example, obviously a large terminal, they publish every day. You see it on TTN. But my point is, if it's like one tank that some guy owns and he says, yeah, I decide the pricing here,
Mm,
and there's very few customers, meaning it could easily be meddled with, we're not going to do that. But like, it's a large reputable company, Global Partners, Buckeye, Sunoco. Yeah, we're happy to operate at any of those terminals. There's a published DTN price that day because at the end of the day, when you think about it, what we're buying and selling is heavily based on that DTN price. So the key thing is we'll operate anywhere where there's not price tampering.
okay, right.
Any other questions from anyone? Happy to go into anything. I can talk all day about this. I actually love this stuff. I think it's fascinating.
No, it sounds like an excellent product, an excellent approach. And what I'm going to do is I'm going to talk to some of our members about this. And you recorded this, right?
I did, yeah, I did
So
record.
maybe I'll suggest to you a couple of our more sophisticated dealers in Connecticut to talk to.
I would love that. That would be great. Anyone else has any questions, feel free to ask now, but also I'm also happy for you to reach out after and we can do one-on-one sessions. I'm happy to go and meet in person as well and just, continue discussing this business. And, everyone, thank you so much for attending today.
Are you
I know I
based
had
in
fun.
Pennsylvania?
So no, I'm actually based in New York City.
Oh,
We did our first deals in Pennsylvania simply because we found a customer that was, very open to talking to us. And it was really great because this customer, we were actually able to really refine our products and give something that the energy really wanted. Because, it's one of those things where you can talk a lot, but then when you listen, because originally when I first created this company, I had like 20 different products. Like I
mhm.
joked, I was like vomiting products. Like, oh, and for this situation and this. And in the end, I realized that's not what the dealers wanted. Let me listen and let me find out the products they actually want. And these three were the ones that we realized really solved 99% of the problems.
Well, in Connecticut as well as New York, we're moving to a B10 product on July 1st, and Rhode Island, I think, is B15. So, are you able to handle that as well?
We're able to handle anything that our customers ultimately want, and we will immediately get the licensing for
Hmm.
dealing with that type of fuel. So right now we're good with anything dyed red. We're good with all of that in nearly every state in the Northeast. But if a customer comes to us and has a potential deal in something, that's different, that's more esoteric, we will immediately get the licensing to do that and then work in that field.
Because in our industry, the big issue with biofuels is that biodiesel future price is uncertain because it's unclear how from the IRS how the producer or blender, whichever one it's going to be, how those credits will pan out. So a lot of people don't know what the price of biodiesel will be next winter.
Right. So right now, for example, we right now are transacting heavily on B20 bioheat in the
Mhm.
Pennsylvania area. We have not had an issue with it.
Right.
And we're happy to keep on pricing and managing out that risk. And once again, the point is if there is a demand, we will do our homework, and we will offer products in that commodity. Right now, most of what we're dealing with is all the tax exempt red dye stuff. But ultimately, we want to expand this business into other areas. We're actually trying to grow into propane. And we just want to build this out where, look, if there's a demand, which the key thing is a dealer offers a fixed price or a cap somewhere, they don't know how to manage this risk and they're looking for someone to back it to. We like to be the ones that insert ourselves in that transaction somewhere that can allow you to broaden your offerings. Look, we're happy to do this too with diesel for construction sites. We're happy to kind of go about doing this anywhere where there's demand and have a discussion and sit down.
Do you do gasoline?
So right now, I have not seen the need to do any gasoline because I have not yet seen someone with, a ton of gas stations that wants to offer fixed prices or a cap to their customer.
Yeah, right.
And but look, if someone had a chain of 50 gas stations and they wanted to really innovate and say, hey, at our family of gas stations, pay us ahead of time or some kind of deal and get a cap or something. It's funny enough, I saw a company in Michigan that did this, but it's really rare.
Hmm.
They owned like 10 gas stations in a suburb. I actually think it would be really cool and I would get the licensing and I would do those deals.
We've had some gasoline members that have done hedging, so it's more to protect themselves. So.
Interesting. Look, in that case, we're happy to talk about that
Mhm.
too. If there's demand for it, once again, we're willing to sit down, meet, do a fact-finding thing, and run it through our models and our software and ultimately get the data that allows for us to price these deals. I view
Okay.
us as we're taking the type of services that, large banks offer to big companies for decades. And my goal is to democratize that, kind of an anti-Wall Street type thing, but do it entirely through physical fuel buying and effectively take this, create an effective software that can quote this stuff at any time and allow for us to do these transactions quick, effectively, and low cost.
Okay, sounds good.
Thanks. I think it is as well. Okay, anyone else, or we're done for the day? Perfect. Thank you everyone for coming today. I really enjoyed this, and please reach out to me if you have any questions.